Thanks for staying with us. You're watching Investor's Guide on ET now. Dhirendra is still with us in Delhi, and Avan is here to give us an introduction into the funds that we're looking at. And the fund in focus this week is the Reliance Long-Term Equity Fund.
Our fund in focus today is the Reliance Long-Term Equity Fund. The Reliance Long-Term Equity Fund launched as a 3-year close-ended diversified equity fund in the year 2006 with automatic conversion into an open-ended fund on maturity. The primary investment objective of this scheme is to provide long-term growth opportunities by investing. The fund's primary focus is on small and mid-cap stocks. However, depending on the views of the fund manager and the market conditions, in the interest of the investors, the fund manager has the flexibility to select stocks from all categories. The fund has given its investors an annualized return of 10.26% since its inception in 2006. The top 3 sectors of the fund are diversified, financial and healthcare. Let's bring in some numbers to get you a better outlook of the fund's performance over the years. If you invested 1,000 rupees in this fund when it launched, you would have 1,550 rupees today. But are these numbers impressive enough? Should you go ahead and buy this fund? Will it add value to your portfolio? Don't get bogged down by all these questions because our experts are here to answer all of them.
Thanks, Avan. Well, if we look at the Reliance Long-Term Equity Fund, 10.2% since launch for a fund that focuses so heavily on small and mid-caps, would you say the returns have been worth the risk?
No, I don't think so. And it has been a reasonably disappointing fund. If you look at return in an absolute sense, then it has been an average fund. And looking at the big turnaround in 2009, the focus on small and mid cap, and given its size, I think it has not been able to compensate for the risk it has assumed and the decline it faced earlier.
Right. If you look at the portfolio, there is 70% invested in small caps, 95% nearly collectively in mid and small caps. So if you were to assess the fund management for us, where would you place it? How do you think the fund manager has been performing?
I would say he starts with a constraint on a fund of this size. 37 holdings, which we know, or average weighted market cap of 2,000 crore, which makes it a really small cap portfolio, and a 1,300 crore. So even unless the fund gets very lucky with some of its bets, when you are running a small cap portfolio in such a large fund, your positions can't be large, very significant. You can't have 5%, 7% position in a single stock. So you tend to diversify across a large number of small caps, and you have to be lucky with quite a few of them. That looks unlikely if the market turns around and gets into a bull phase of a kind which we saw before 2008. Till that time, I think this fund has the potential to deliver only average or below average return relative to what is derived from the market, and also a potential decline if we face a disappointing market.
Right, and finally, your rating of the Reliance Long-Term Equity Fund, what is your star rating and what's your final verdict on this fund?
Based on the risk-adjusted performance relative to other funds in the category, it is rated as 3-star. But going by my understanding of the portfolio, the spread, the size, I think the real risks are not reflected in this rating. I would give it a 2-star.
2 stars there, going out to the Reliance Long-Term Equity Fund on Investor's Guide. But then there's something I wanted to talk to you about. We know that the RBI, in its credit policy this week, increased savings bank rates from 3.5% to 4%. Now, this change has come after a while. There is, of course, an interesting concept of the fact that 4% is what your savings bank account is paying you, while all of the other interest rates that you pay on your loan, the interest rates you earn on your fixed deposits, are so much higher. It actually points out the fact that you're not beating inflation, so your savings bank account is not some place where you should be keeping a lot of money.
Absolutely. I think if you have large amount of money lying in your savings bank account, it is unfair to yourself. I think one can say that it is very unfortunate if you have such a situation. Make your money work harder, that does not mean that you have to get into equity, but optimize your return, and there are superior ways of achieving it. All that a savings bank account serves is, it should be money in transit. For example, our salary is getting credited in our account. That money can well lie there because I'll be paying most of my bills from that savings bank account. or my emergency fund. If I've decided that I should have 50,000 rupee or 1 lakh rupee which I need to drop on any time and go to the nearest ATM to pull it out, I should keep that money. Any money beyond that which I'm unlikely to need in a foreseeable future, or in a defined time frame beyond 3 months, it should not lie there, and that is injurious to your financial health. It's a missed opportunity.
Yes, you don't need too much money lying in your bank account. The other change that came, of course, was in income funds. We know the RBI caps the amount of money that banks can invest in income funds. But these liquid funds have been giving about 6 or 7%. So in comparison to the savings bank account that we were just talking about, would liquid funds make more sense for investors?
It will make sense for an investor who is living in the top 10 cities and understands what a mutual fund is and has tried out. And maybe if you have any money beyond 10 lakh rupees, it could well be meaningful, because getting 2-3% more, and money which you and for example, if you have created your down payment for house and you are looking for a house, that money should be in a liquid fund, because you are not likely to need it anytime. You will always have 2 days notice, and then you can take it out. So all that money, a sizable sum. But if you are thinking of 2 lakh rupees or 3 lakh rupees or your emergency fund, that should not go to liquid fund. It is not worth the effort, because the incremental difference and the loss of convenience makes it inappropriate.
Dhirendra Kumar, thank you so much for joining us on this show and answering our questions. We look forward to sitting down with you again next week. Now, if you have a question for Dhirendra, write to us. There's an email ID at the bottom of your screen, or you can reach us on Facebook, facebook.com/investorsguide. On the other side of this break, Vishal Kapoor is going to join us to answer more questions on your investments. So don't go anywhere.